Financial markets function fundamentally as machines designed to solve a singular problem, facilitating transactions between anonymous parties who lack mutual trust and immediate alignment on price or size. Liquidity is the term for how efficiently this machine operates, and it is best understood as a physical property, similar to viscosity in fluid dynamics. In a liquid market, large orders pass through with minimal resistance. In an illiquid market, the same order acts like a boulder dropped into a shallow pond, displacing price violently in every direction. The structural purpose of liquidity provision is to manufacture immediacy. Because natural buyers and sellers rarely arrive simultaneously, market makers bridge this temporal gap by warehousing risk. The bid-ask spread is the fee, essentially rent, paid to these actors for pricing patience rather than predicting direction. For the long-term investor, the primary error is treating liquidity as a binary state based on daily volume. High volume does not guarantee the ability to move significant size without price impact, especially when that volume is distributed thinly over hours. Furthermore, liquidity is pro-cyclical. It is abundant when it is least needed and evaporates the moment volatility spikes, as rational market makers widen spreads or withdraw to avoid informed order flow. Modern execution architecture reinforces this. Most retail orders never reach a public exchange. Instead, they are routed to wholesale internalizers who manage trades from their own inventory. This system is supported by clearinghouses like the Depository Trust and Clearing Corporation, which act as the central counterparty to every trade. While this architecture ensures settlement, it introduces margin requirements that can become systemic bottlenecks during periods of high volatility.
The bid-ask spread is the visible cost of market machinery, composed of three distinct economic buckets: order processing costs, inventory risk, and adverse selection. Adverse selection is the most critical for understanding market behavior during high-impact news events. When a market maker cannot distinguish a retail seller from an informed institutional actor, the rational response is to widen spreads across the board to mitigate the risk of trading against superior information. This friction extends to order routing itself. Because liquidity is fragmented across numerous public exchanges and dark pools, executing large orders requires sophisticated smart order routers to slice trades into smaller pieces. This reduces market impact, which is the degree to which a fund's own buying or selling moves the price against itself. Institutional participants view liquidity as a constraint to be engineered around, utilizing algorithms like the volume-weighted average price to hide their footprints within the natural market flow. This has created a technological arms race with high-frequency market makers. These participants do not trade on fundamentals, they trade on the structural insights derived from order flow, measured in microseconds. By detecting the first fraction of an order at one venue, they can anticipate the remaining flow at others. This is the rationale behind co-collation, renting server space physically adjacent to exchange engines to minimize transmission latency. For an investor, understanding this hierarchy is vital. It reveals that the market price is not a static fact, but a result of mechanical competition between speed, information, and the necessity of hiding one's intentions from the rest of the chessboard.
Liquidity is a confidence-based mechanism that functions until systemic stress exposes the fragility of the underlying plumbing. The January 2021 GameStop event was not a conspiracy of intent, but a failure of margin mechanics. As volatility spiked, the National Securities Clearing Corporation's risk model demanded massive collateral increases from brokers. When the capital wasn't immediately available, the pipes physically could not support further buying. Similarly, the 2019 repo market spike occurred when bank reserves and Treasury collateral supply misaligned, forcing the Federal Reserve to intervene. These episodes demonstrate that liquidity crises often stem from ordinary events colliding in a system with insufficient slack. The Federal Reserve manages this through two primary valves: the standing repo facility, which caps interest rate spikes by providing cash against collateral, and the overnight reverse repo facility, which sets a floor by allowing money market funds to park excess cash. Additionally, the Treasury General Account acts as a significant liquidity driver. When the government spends, cash enters the system. When it issues debt to rebuild the account, it drains liquidity. These macro flows are upstream of price action. When combined bank reserves and repo balances drop, dealer balance sheets constrain, leading to increased volatility and wider spreads in the Treasury market, which eventually cascades into equities. A sophisticated investor treats liquidity as a valuation input. Assets that remain liquid during a crisis deserve a premium, while patient capital can exploit liquidity-driven dislocations. Recognizing when a price drop is caused by broken plumbing rather than deteriorating fundamentals allows for high-conviction positioning when the rest of the market is forced to sell.